It's only the first full week of the year, and yet it feels so long since some of what kept so many of us up during the holidays. Some people are sounding the all clear. Others are claiming new storm clouds are on the horizon. We're going to explore where we're at today, and even more importantly, some concepts to help you get through whatever does lie ahead. So this week we're going to continue on the topic we started in some ways last week of getting you to focus on things that can be constructive to your financial well-being, as opposed to, again, the annual rituals of the coulda, woulda, shoulda of the year that's been, and trying to predict the year that will be. And to that end, we kind of have three big areas that we want to touch on, generally speaking. Number one is understand your time frame, and really time frames. So what I mean by that is have a plan both for the short-term cash flow needs, really identify those intermediate needs in terms of college or vacations, and then the longer-term plan of retirement. Or if you're retired, understanding that there's a lot of years left after retirement that need to be accounted for. And so again, when you're synthesizing your plan, maybe even synthesizing some news, keep in mind, is this commentary relevant, and is this plan relevant for the time frame in question? And that a good plan and even a good portfolio has a lot of different time frames accounted for within it. Yes, it's one portfolio or it's one household balance sheet, but it needs to reflect a whole lot of different time frames and goals in between. Number two, focus on what you can control. You can't control the markets, obviously. Markets don't care or even know about your timing, but you can control saving and spending. You can control the risk that you take within your portfolio and whether that's appropriate from both an emotional perspective and a financial perspective. And you can have a strategy that can help you get through whatever is to come. And while that's all true, again, people spend far more time worrying, planning, and thinking about what they think the outcome is of a certain headline news factor. But if you ask many of those same people how much they spend on a monthly basis or save, they either don't know or they don't have an accurate picture of what they may be. So again, focus in on those things you can control. With respect to that last piece, strategy, we want to talk about creating both a mental framework and a financial framework to get you through whatever lies ahead. And that's our topic around backfills and bridges. So what I have to my right here is my take on a stock market chart, obviously not historically accurate, but it has the general makeup, some volatility, a general upward trajectory, and it'll work for walking through the two concepts that I want you to spend some time thinking about. Number one is backfilling. Whether you're still in the accumulation phase, you have a job, the ability to save, add to your company 401k, these opportunities become great opportunities to build wealth, not something you need to live in fear of, because of your ability to backfill, again, if you will, dollar cost average into those positions and not have to buy on just some type of a long-term average, right? If you do the math, there's plenty of things you can Google up on this. We don't have time to talk today. You'll see that your ability, if you're dollar cost averaging along the line, will lead to a higher number than if things just moved in a nice straight line and you had to buy along the way. So again, have a plan for it financially and emotionally. Understand that this is something to be excited about, as painful as it can be in the short term. Even for those of you in the distribution phase, post-retirement, you can still in your own way backfill within a plan, assuming you're properly diversified, by taking some of those conservative positions to buy down some of the more aggressive parts of your portfolio when they get depressed. So again, that's a concept that can work for everybody. Most critically, for those of you in the distribution phase, we keep talking about it because we keep seeing plans that don't have it. Have an income plan, have that bridge that can get you through the moment so that you're not having to liquidate shares along the way. If your plan is based off a total return strategy with very little income generation and long-term market average assumptions, there's a high probability you get hurt. For all those people who retired here in 2008, that's why they had to go back to work. They didn't have a plan that could help get them across the way. And while backfilling is great, For those in the distribution phase, one of the critical pieces you've got to have in place, in addition to diversification, is this income bridge to get you across this valley when they come about. We're going to talk a little bit now about where we see the market headed to get people prepared from an emotional perspective. Not to come off as a hypocrite about trying to predict the future or mitigate the backfills and bridges type plan. We do that stuff because that is critical to one's long-term financial success. We talk about this next phase and offer our own insights about where we think we're at and where we're headed, not because it's more important, but because at least it's a piece of the puzzle to be emotionally prepared for what might lay ahead, so we don't get surprised, shocked, and do something we might regret in time. Where are we at today? I'll make this pretty brief. Fundamentally, things look pretty good. What do I mean by fundamental? Earnings. At the end of the day, despite all the emotions of the short-term moves of the markets from fear and greed and everything else, companies are going to make a certain amount of money. They're going to get valued according to historic metrics, and that's going to result in a certain share price or market price. Since the market's peak in September, revenue guidance is up. Earnings guidance is still net positive from that point in time. Yes, some of the growth rates have mitigated, but that's been reflected in a lot of the market pullback, which now has the market sitting at about 14, 15 times earnings. We went from deeply oversold in December, and we talked about this in last week's writing, to now probably a little bit overbought. On that fear and greed index dropped down to 4, it's up to about 30, still fearful, but a bounce. So I don't think this is a time to go hog wild into equities, but again, a lot of, again, a more intermediate to long-term perspective, things look pretty constructive. A lot of it's baked in. Headline news, what do we make of it? Brexit, nobody knows. That's the one area where we still have some concern. In terms of the trade, that looks pretty positive. Again, we've said this for some time. Both sides have a lot of reasons to get that done. That being said, I wouldn't be investing according to that because the time frame of exactly when it plays out, though we do think it'll be this year, is still be very much up in the air and could have some twists and turns in the meantime. The government shutdown means little to nothing to the market. That's been pretty obvious if you've paid attention to headline news versus market performance here over the last couple weeks. And when it comes to the Fed, probably the thing that had us most concerned on an overall basis, we're starting to see some more constructive dialogue from the Fed in terms of slowing down their rate of interest rate hikes, and we think that'll be a positive. So all that's to say, one non-factor in terms of the government shutdown, one, still negative in the terms of Brexit, and the other two are pretty positive. So on the whole, things look a lot better than they did a month or two ago, and we would caution people to, again, from a short-term technical level, not get too bullish, to expect some continued volatility, but we still think things are shaping up to at least stabilize from a more intermediate to long-term perspective. With that, we again wish everybody a happy new year. Look forward to introducing two of our new colleagues in the weeks ahead. We've got Adam Gelhausen, who's joined our firm officially, and Dave Gordon. We want you to get to know a little bit more about some of the talent that's joined our firm, and we'll be helping those of you who are clients in the near future. Thanks so much.